All right. Good morning, everybody. We're back. One day. I don't see any other appointments on the horizon, so it should be business as usual for a while. I have the spot gamma levels already up on the screen. If you want to capture those, get a screenshot. So this is the founder's notes from Spot Gamma yesterday afternoon. This isn't the morning one yet. But we can see that they had non-farm payrolls this morning as something to pay attention to. And then next week on Wednesday, CPI, Thursday, PPI, and then OPEX on the 19th. Now, I'd rather see them the morning gamma, but we'll take what we have. And it is positive, not by much, but it is slightly positive. And their range still is less than 1%, so 0.89. That's usually where theirs sits at. So we got Fed speakers, Bullard and Cook. The non-farm payrolls is kind of a big one. We're likely to see the same kind of volatility that we saw with FOMC during the non-farm payrolls, especially since it's one of the data points that the Fed focuses on all the time, right? So this one has the potential to give us a couple of different setups. When we come into FX Street, where they have the impact gauge, we can see it's dark red, right? If you're kind of newer to trading all of these different economic events, it kind of gets a little daunting, right? Which ones should you really pay attention to? Which ones kind of don't really matter? And if you are feeling like that and you don't really know which ones to pay attention to, coming over to FX Street is a good way to go. It's free. It doesn't cost you anything. You can sign up for an email with them. Just approach that with caution, because man, they will spam the hell out of you with emails. So you don't have to sign in. I'm not logged in. I don't honestly recommend getting an account here. You don't need it, but it's a good place to come over and check out their calendar every day, because it does highlight with this little barcode here which ones are anticipated or have a history of being highly impactful versus not so impactful. It doesn't mean that it won't be, right? Just because something normally doesn't impact the market very much doesn't mean that it can't or that it won't. I was trying to really think about the narrative for the day, and I think this really sums it up nicely. I'm kind of, if I have to miss a day, I would rather miss a day that looks like that. And I did miss yesterday. I didn't even get into the office until nearly power hour yesterday. And this is what I came into, nothing. So I didn't feel that bad for missing anything. I didn't miss nothing. Talk about what is difficult to trade. While I could find something in there to trade, it would be a slog. There's really nothing in there that looks exciting. All right, so we got China here on the weekly. If I zoom out a little bit, that inverse head and shoulders along the lows really starts to stand out, but it's a weekly chart, right? So it could take months for this thing to unfold and turn into, a breakover that takes us back up towards these highs. A half a year or more to be able to make that move. And that's if it stabilizes. So we're inside day, doji week. This is the second week in a row where we have a lot of indecision, a lot of defense along these lows from the April 17 week. So we just, keep our eye on it, see how it plays out. Keep track of those Hong Kong names, right? For a while, everybody was waiting for them to open up. A lot of money was flooding into that direction, but all of that's done now. And we're on to the next latest and greatest. Still, there's a lot of KWeb names, China ADRs. They get their pop, right? Their little place in the sun. Japan gapped up strong, still dealing with this wick back here from August. But we've been in this range for a long time, over a year. And we're threatening to break out of the top of that range. So it's a really big deal. There's a whole lot going on over in Japan. They got new leadership at Bank of Japan. They are talking about changing a decade old policy and doing something different. There's just a whole lot going on over there. A lot of things behind the scenes that I don't think are getting enough attention yet. But somebody is awake over there. And, Buffett already went over there and started digging into things. And that's why we started to see gold and precious metals and miners get whacked, right? US dollar Japan started heading to the upside. That put pressure on precious metals, so they're not moving up like they were. I wouldn't sleep on this. I think it's worth looking at, especially, if you want to trade. If you want to trade it, you can mess with the Invesco ETF, right? If you don't have like US dollar Japan or something. Getting an FX account is a pretty simple thing to do. Even as a small account trader, you can trade it in an FX market. So something to think about for you small account traders out there. Europe's still heading to the downside. They did raise. Someone much smarter than me suggests that they probably will not raise again, right? Just like us. It's a pretty common bet right now that the Fed is done raising at this point, even though they didn't exactly say that. It was put in as like a hawkish pause, right? And we still have that TRB set up. It failed. All right, we were supposed to see the follow through and we didn't get it. So what we do have right now is an IX10, and on a weekly, no less. So we're trapped inside of this April 10 week, and it's a really big week. When we got an IX10, we want a really narrow, tightly focused range, not a really big, wide range like this. So we got the range, and it is IX10, but it's not overly exciting when it's that big. But still, it sets the limits, gives us our boundaries, and now we just need to get out of this box. If we close for the week inside of this again, then we want to focus on next week and perhaps getting away from the April 10 and having one of these others become the boss candle for an IX10, maybe a little lower down, right? Say this week becomes the control week. So it really just depends on how we close this week and how we open next week. It very well could be that we're done with the dollar and we're going to continue to fade out. Right? Obviously, not all at once, but a little bit at a time. We had that conversation last year, right? When we were calling it at about 112, 114 area, that it was pretty much done. The really good thing about these morning briefings is that they're dated, and you can go back and listen to the conversations from, October and kind of hear that discussion of we're done, right? And kind of turning around at that point. This does have implications for the bigger picture, but only to a point. We talk about the dollar breaking below 100 and how that should galvanize the S&P, or at least take some weight off of it and allow the S&P to really rally up even more. But you got to kind of take that with a little bit of perspective. So here we got the S&P, put it on a weekly. Now, there's a lot of analysts that say we're done with the lows. We won't set new lows. We could get weak. We could certainly come back and retest, that 3,800, but that we're very unlikely to see 36 and 35. And, that we're basically done. We're going to hold above the 200 week. Some of those same analysts say that this is going to be the year of the sideways, the year of the chop, that we're just going to, really just chop around in here without setting new all-time highs, but without breaking down below, say, that 200 level. Which, that leaves us 800 points in a range that we can just chop around for the year. But with the dollar breaking down below 100, you really have to kind of believe that we're going to break above 4,200, a level that we haven't been able to sustain above since August. And we didn't sustain that, right? We went above, we tagged the 200 day, and we took a beat down, and we've never been able to get back up there again. So the dollar below 100, really think about the S&P above 42. I don't think we're going to 48, but if you're selling calls out there on, say, the MES or the ES, maybe you want to let it break that 4,200 and challenge 44, be this old August high. 43.50, I'd give it an overshoot to 44, and then load the boat on some calls up there to kind of sustain you for the rest of the year, right? That's my plan anyways. Otherwise, if we find stability in the Dixie and we start rallying back up to 104, 105, then we should anticipate the S&P retesting that 38.50 area. Cool. Yeah, you like it. Financials are doing pretty good this morning, I see. All right, so after we get done with the 8:30 econ, we're basically done for the day. The Hughes rig count really should not have any impact on the market unless something drastic happened where we just lose an entire fleet of drilling rigs. There shouldn't be a drastic change. And that's really something that's only a threat when they come out with a new line, right? Like a new flex rig series or something. You bring a bunch of brand new pieces of equipment online, you got to expect that something could go wrong and then they all go offline. But we haven't had that kind of changeover in a long time. So shouldn't see a significant change to the rig count. And that means that you can basically ignore that one. Consumer credit at 3 o'clock, but that gets us into power hour anyways. And it's not one that I would really be too concerned about at that point, because I mean, it's power hour. So we look at the volume this morning, it's a little light, nothing too bad. And it makes sense that it's light because we've got data today. We have a market maker move, which reminds us that the data this morning is very likely going to be impactful. You don't see this unless there's something going on. We're looking at the futures, but you can see a market maker move on anything that has options. So what we often see is a market maker move for earnings, or when say a drug company comes out with a new product, an investor day event, some thing, right? So with the ES, when we see that there's a market maker move, we know there's something on the horizon that the market believes has the capacity to be impactful. Now, market maker move is something that Thinkorswim invented. They coined the phrase, they really came up with the whole thing. So if you want to know more about what the market maker move is, you can go to the Thinkorswim's publication page called the ticker tape and just search for market maker move. They have like 50 articles that really go in depth on what it is and all that good stuff. As a shortcut, just to kind of give you a quick rundown, when the front end has a higher implied volatility than the next series out, you get a market maker move. So we want to scratch this one because it's from yesterday. And that leaves us with the current 0 day at 19.2 and the next series out at 14.2. It's 5% higher than the previous one. And that's why we've got a market maker move. That's all that it is. And I've heard some really smart people screw this all up. I don't want to name them, just shame them. But I mean, if you don't know, just say you don't know. Make some crap up and confuse people. Anyways, we do have a nice little setup this morning that I like. I don't know if we're going to get it or not, but I want to point it out to you guys, because every time we have this setup, I get excited about the opportunity to trade the darn thing. So the easiest way to find it is to go where I know there has been the same setup before. Widen out the chart to say 180 days and go back to the 13th, say December 13 or November 13, either one of those, because we had a CPI and we had a PPI right around that 13-14 time frame. All right, so there's January. I might not get there in 180. Thinkorswim is still loading. All right. Are you done yet? I think I broke it. And just give it a minute. It's almost done. Hey, it's done. All right, so here's a negative version. When you get an economic event and you get this big, massive candle, that's a gap. It's a liquidity gap. So you don't see a gap, you see a candle, but there is a gap there. Then what happens is the market spends the rest of the day working to close that gap. Whatever happens after that, but it's really going to focus on closing that gap first. And that's what we get here, just a constant push to get back up there and get that gap closed. Here's another one in the other direction, and it wasn't as big, right? This one is much more mild than the other one, but same thing. We get econ, it pops to the upside. It spends the rest of the morning getting that gap closed, and then whatever comes after that comes after that. All right, here's another one. This is on the 15th. We get the economic news. We get this really big spike. The market spends the rest of the morning getting that gap closed. And I refer to this one a lot from that pin bar, right? Where it came down and it stopped right, it just tagged it and up we went. And we can see all these wicks down here where that unfinished business was getting finished until finally it was, and there was nothing left there, and down we went. Think about swinging an axe at a log, and you keep chipping away and chipping away and chipping away until there's finally nothing left and your axe goes through the wood. There was something solid down here. Call it whatever you want. I like to just use something simple like liquidity. There was liquidity here. We kept chopping into it, hitting it, absorbing more and more and more of it until there was nothing left. And down we went. So this morning, we have the potential for this kind of setup that we're going to see a really big pre-market candle and up or down, right? I don't care. We get a really big candle driving in one direction very cleanly. So we don't want this kind of wishy-washy up and down and big doji and wicks on each side. And we don't want that, right? That's not what we're looking for. Big solid bar in one direction. We get a close near the high of that bar, and then we don't get back above that highest point. So here you can see, call it this being the midpoint. We set the high, pulled back off of it, closed in the upper portion, and yet we never went back up and tested that high again. It spent all of its time and effort and energy getting back down to the origin of the breakout to close the gap. So we have that setup potential today. One thing that we sometimes get with this kind of setup, once we fade off of it a ways and we come into the open, price will make a drive like it's going to come back up and retest and roll over from those highs. Same thing from the lows, right? If it was a really low print and then we pull up off of it and say we open around this area, we often see price try to test it and then run. All right, so here this morning, we've already got a high I really doubt that this is going to have any bearing or impact once we get non-farm payrolls, but we're very likely going to get a much bigger, hopefully a very nice clean bar, up, down. I mean, I don't care really. Just give me something and then we'll work with it. No pivot point is going to interfere with this bar. All right. So trying to mark out some levels and validate or identify how far price could go when the data comes out, you're wasting your time. We have moved the full ADR this morning, or ADR half, I should say. So here is the open. This is half the ADR in each direction, which gives us the full ADR when we put those two lines together. And we're above it and kind of resting on it. A little bit of a doji play there, or excuse me, not a doji, a Busby. But there is a higher level, 41.25. That would give us an inside day breakout from yesterday. And then get us up to that 41.25. And there's really nothing else up there that we have to be concerned about. We made it through that gap. This is a gap that I had mentioned the night we got it. When the market closed at 4, we continued to see movement. And by the time it opened in Globex, we had this really big gap down. So normally when we deal with gaps on the futures, we're really looking at where the market closed yesterday and where it opens this morning at 9:30. That's the gap that most people talk about. But sometimes the market moves between 4 and 5 because the market really isn't closed at 4. It's just closed to you and me at 4. The institutions, the firms, they get to still trade. And then there's the settlement, right? So we still see price move. It just doesn't usually move that much. It moved enough to where we had this really big gap. And hopefully it was something that you guys focused on yesterday, because that would have been a really great trade off of the high. Basically the only trade of yesterday worth its salt. And it doesn't even look all that good for a follow through, just a big sandwich. But either way. Depending on how the jobs data comes out this morning, I really think we're going to make it back towards that 4,200 area next week. But it really comes down to how how the data comes out today. You can see after the FOMC, the market really didn't like what it heard, but it thought it through, and Apple didn't crash and burn. So that helped a lot. That was one of the big unknowns. And now we're kind of stabilizing and beginning this rounding move back up. But we still have to get through today, right? So once we're done with the jobs data, that's it. We should be good to go with nothing really standing in our way economic wise for a while. I remember how I started this today. We were looking at spot gamma, and then the things on their list that they deemed worth kind of looking at for the future. CPI and PPI next week on the 10th and the 11th. So we should be able to, have a pretty decent move through the market into that once we get through today with the job numbers. Because of the way things are this morning with this market maker move and everything else, let's just go ahead and add some extra levels here. So we don't have an MDP. We've already interacted with the daily pivot point, but we are down at the previous week's low. We broke through that level yesterday, had a really nice bear trap double bottom trickery. And so far it's kind of holding the line. That 41.25 is just looking at the ADR. It doesn't add in the market maker move. So at the very least, we could add the market maker move to that. It would be another $26. So from 41.25, we could just look at 41.50, which is where that purple line is, and it's the weekly pivot point. Generally speaking, when we're underneath the weekly pivot point, we're bearish. When we're above it, we're bullish. But having said that, when we're underneath it, but we're going towards it, then we're changing from that bearish posture to a bullish posture. So 41.50 is where the market maker move lines up. It's one way to know that your pivot points are accurate is when you get the same data point from multiple sources. You're avoiding multi-collinearity, which is like the echo chamber, right? If you listen to politics, and maybe you've heard that phrase before. If all of your indicators are only looking at price and it's ignoring volume and volatility, and then all your indicators are just from one data point. You want to spread things out so that you get data points from different sources. And then when they all line up, that's confluence. They're a lot stronger. So that weekly pivot point, just because it's a weekly floor pivot, I wouldn't give it too much credence, right? That's just a mathematical formula that gives us a weekly pivot. I'm not going to put a lot of trust or faith into that. But now it's not just the weekly pivot, it's the 41.50, which is a gamma level. It's a tier 1 alpha level. It's the market maker move pivot. Now it has a lot more weight, right? Because now it's not just 41.50, the weekly pivot, it's 41.50, all these other things combined. A lot of resistance. But resistance points are magnets at this point, right? So it's very likely that we're going to gravitate to that if the non-farm payrolls this morning is bullish. That makes sense, right? Maybe it's too early to get all nerdy. Yeah. Uh-huh. Well, what's up with the semiconductor ETF acting all goofy this morning? Hmm. All right. Well, SMH has a data print issue, I guess. It's the only thing I can think of. Maybe they did an adjustment with the ETF, and probably by Monday the brokers will have this changed to where it won't do that anymore. So I would just kind of set SMH on a back burner and use one of the other semiconductor ETFs. So NVIDIA is still holding up well. It really just doesn't want to give up. I'd say it really needs to maintain above that 20, which is the green line. But you can see that we're very close to getting a crossover between the 4 and the 10, be the white line and the blue line. That's why the bearish surge is increasing and we're getting a decreasing bullish momentum. But it's still in a bullish trend and it still has bullish strength. So, a little bit of caution on the shorts. When you look at it on a week, that's still not bearish. So just a note of caution, right? On the weekly, that thing is not bearish. So we are up a little bit. We're at 277. Even if we do get an inside day breakout, we've still got 5-3 to deal with, which is another really big indecision day. So a breakout to the upside just doesn't look really enticing at all. Even as a day trade, there has to be something better to day trade than this slop. Getting an inside day breakout above that white line would really just get you tangled up into 5-3s price action and then price 5-2s low, right? So got a lot of trash here to deal with. The only way that Nvidia looks even remotely good to day trade is if we do break the 20 and we start heading down. If we break the 20 and we start heading down, then getting this gap closed at 262.34, that would be something worth really looking at. I like that. But for a topside breakout, I'm really not interested. $262.41. Now, I don't think it would get there in a day, right? So, we are up this morning at 277. So we're talking about sitting in the upper portion of yesterday's price action. If we were to dump, we would have to get through all of yesterday, then the 20, then the breakout of yesterday, and then the move to the downside. So if you're looking for a setup to know to go short, at the very least, get through the 10-day, which would be the blue line there, the cyan line, then get through the close of yesterday. That's a decent pivot point to keep your eye on. And then the low of the previous day, the 20, the low of yesterday. You can see all these pivot points to be like signposts or goalposts for the trade. If we break 272.40 today, I think we could expand 100% of yesterday's candle today. So you're looking at, say, 266. That'd be a nice move. To be an $11 move nearly from our current location this morning. I don't think it's going to do that, by the way. I'm just saying that would be the play, not a topside breakout. There's too much trash overhead. All right, AMD. After a company reports like this, and it kind of just breaks the chart to do any sort of TA, you're better off just going out to the weekly at this point and ignoring that broken daily chart. We're down this morning at 85.70 when we closed at 86.60. So we're still, obviously we're inside yesterday's range. Yesterday was such a big range. It's digesting a lot of that. Inside week, I don't think we're going to get a lot here out of AMD for a while. And it's certainly too soon after earnings to kind of consider, you know, like, where do we go from here kind of thing. We are back above the 200. So that's one of the few positives that we could say, no matter what that earnings looked like, and it must not have been good considering the dump down that we had. It did manage to rally back up above the 200, but it's still stuck underneath the 50. And the gap is closed. So I would caution any of you bulls, because this gap might have been the only reason that it went back up, just to get that gap closed at 90. And now that it is closed, it might not have a reason to go back up again. Yep. Yeah, I haven't got a chance to read it yet, but I heard that there was news on AMD and Microsoft also. Thanks for pointing that out. One day I'm gone and it's like a black hole of mystery. There's a million things it seems like I missed yesterday that I have to get caught up on. It's going to take a week to get caught up from one day. Exhausting. All right, Netflix is sticking itself down into this wedge. It's kind of the can't stay here setup. So when it comes to wedges, price rarely ever gets all the way to the end of the wedge, right? Usually there's a cutoff point. Some analysts say it's around 65 to 75%. You could say that it shouldn't get past the 80% mark, right? Which means usually there's this 20% of the wedge that doesn't get price. And that's usually where you start looking for your breakout. And, you know, price can do the fake breakouts. First, it can pop up, suck up all the bulls and then dump it on their head. Or it can break down first and suck in all the bears and then spike it and rip them and make them puke. So the direction of the breakout is, you know, kind of more in question. But the fact that it's going to break out is not in question. When you get to a point where you have price in a wedge and it can't stay here, it's got to get out of this zone. And I know that might sound really obvious, but it's not. And I can't tell you how many people surprise me when they say, well, I don't know, I didn't think about the fact that it was going to move. Yeah, it's going to move. So Netflix, by the way, is a mover. This thing has been called many things, including an account killer, by some pretty famous people. It is a dangerous monster. It survived earnings, even with this gap down. It was on the Seeking Alpha bullish list of 2023 back in December of 2022, right? They were doing like contrarian bull thesis plays, and this was on their list. And think about what it's done since January 2023. I'd say Seeking Alpha called it pretty good, right? That was a pretty nice run up for 23. It was. And then it topped out and it hasn't been so hot. But now we're in this wedge. Can't stay here. It's got to get out of this zone. And the fact that it stabilized after earnings without crashing and burning, and you could bring in, the new subscriber pool that they have access to, and the lowered data costs, which makes it easier for their subscribers to even be able to watch their shows and all the other macro stuff behind it. I don't know. I think there's still got more to it. It certainly has a lot of issues, right? I'm certainly not saying that this is a well-run, oiled machine of a company, but I like the fact that it's still surviving after that earnings, and that we're wedged up really nice. This is a chart that's healing, right? So I kind of like that TRB play. All we got to do is get out of the 5-2 candle. And I don't think that these 4-8 and 5-1, I don't think they're going to mess with us. It'll be a solid breakout. Should easily take 100% of the 5-2 candle. I like it. We just got to get it. So we are up this morning. We closed at 320. We're at 322. 323 should get us the breakout for the 10-day. We do have the 20 and the 50 overhead, but they're basically sideways, or at least that 50 is. And sideways moving averages that we've already crossed through multiple times, they kind of lose their respect at that point. From a 0-day perspective, there's a lot of names today where you could just put credit spreads at yesterday's lows and run them into the close today. I mean, I know that might sound a little lazy, but it works. Especially with yesterday being such a sideways narrow day on a lot of names, that should work out pretty well. Still wish I knew what was going on with SMH. They're probably rebalancing, but still, very likely by Monday, you'll see a normal chart again, with the new price being the normalized price. All right, we got 10 minutes until econ. We can see how after earnings, volatility really sold off. This shows how much AMD was not AMD, how much Apple was a threat. The earnings for Apple loomed so large in people's minds as this make or break, and they better get it right or else, right? Because Apple makes up so much of the indexes. So once we got through that earnings and it wasn't a complete dumpster fire, we can see the VIX really sold off afterwards. That says a lot about how impactful the Apple earnings can be. They weren't, but they could have been, and that's where this threat now is being sold off. There's still one to go when we talk about threats. We still have the non-farm payrolls today, and then next week CPI and PPI. The thing is, CPI and PPI next week aren't holding the same amount of weight as Apple's earnings was. Maybe that's a little sad, right? But that's where we're at. I still don't see us getting below 17 in the VIX, and sitting in this range isn't helping us at all. So, trying to gauge or define levels below 17 and above 21, that's really wide and not really helpful. But it's all we got. All right, bonds are down, gold is down. The KWeb China constituents are up this morning, and biotech, which has been nothing short of an absolute rocket ship to the upside, is back up again this morning. Biotech names are like the dash for trash now. Bitcoin up this morning, which is a liquidity tell, which ties in with emerging markets and the KWeb names. I feel a little blind without the semiconductors. But if we were to list them out, and I know we've got the data point coming here in just a minute, but if you list them out, you got KWeb, that's bullish. You got Bitcoin, that's bullish. You've got finance, that's bullish. We don't know about the semiconductors because the semiconductor ETF is shot. But if we went in and looked at them individually, they didn't look bearish. So maybe flat to bullish. So semis, emerging markets, bullish. Across the board, all of our high data point, everything is bullish this morning. We just have to get through non-farm payrolls. Yeah, look at finance this morning, KRE. So the banks, being such trash, are getting a little bit of a rebound. Yeah, that's not bullish, right? That's more of a reflex, like grabbing something hot on the stove and reflectively letting go of it. This is a reflex bounce. So that's not bullish. I'd be looking for a new place to short that sucker, because they're not done. But they are providing a little bit of a lift this morning. If you're thinking about shorting the S&P, watch the financials, because once this rallies into resistance and rolls over, think about what we got right now. We fell and we bounced off of support. We're going to rally into resistance before rolling over and continuing to dump down. So I'd be watching for a little bit of a capitulation move like this, a little blow off top, right into resistance. Once that sucker rolls over, takes the S&P with it, and Bob's your uncle. And all the tech names are starting to pause or roll over. So we can see Apple here already rolling over, kind of rejected off those highs, and now it's going to try to test the lower end of this price shelf. But that's just Apple, right? It's not enough on its own. Microsoft rejected off of the Globex high again, a little micro double top. It isn't breaking down yet, but it's certainly paused in that rally. Google, same thing. It just paused there. And it makes sense for the pause. In 5 minutes, we're going to get data. So everything's just kind of holding in its breath. You can see how far we are outside of the weekly expected move. And remember, we went 4 weeks without even touching the edge, which set a new record, by the way. We had never gone 3 weeks without hitting the edge until now. So we've got that as a data point. But then we hit the edge last week. We still managed to close inside. This week, we not only hit the edge, but we broke out of it. Now, if you're not used to using this weekly expected move. It's supposed to define price within a range with a 70% accuracy on things that are not the S&P. When it comes to the S&P, it's more of an 80%. Price closes inside of this box 80% of the time. So when it doesn't, it stands out. One close outside, that's nothing. Statistically, that's going to happen. But what you want to watch for are multiple closes outside of the week. So 2 weeks, 3 weeks in a row outside. Or if you count back over the last 10, closing more than 4 out of the last 10 outside of that box, that's significant. It really stands out. If you go back to pre-COVID, when the January, February highs and the market at all-time highs, right before everything dumped, start counting back at how many weeks we broke out of that box right before the dump, not after everything started to fall apart. And before everything started to fall apart, that thing was giving us a ton of warnings. We didn't know what it was. We just knew there was something wrong, right? So this is just the first week and the week's not done yet. We could rally all the way back up and close inside the box again. As crazy as it sounds right now, this morning, that we could do that, we could still totally do that, even today. Especially after 3 down days in a row and having hit this structural support and being up in the pre-market and having non-farm payrolls right on deck, we could rally all the way back up and close above 4107 today and be back in the box. Everybody, enjoy your weekend. Have a good day. Be careful, be safe, and I'll see you all next week.